Interest rate buydowns are the hot topic in our industry today, mainly because interest rates more than doubled this year. When it comes to buydowns, it's important to understand what the available options are to make the right choice for your specific scenario. Failing to do so can cost you thousands of dollars. This is Michael Menino with Harbor View Funding. Stay tuned to learn the pros and cons of each and what option is the best for most homebuyers in today's market. You have a couple different options when it comes to buying down interest rates. You have permanent rate buydowns where rate discount points are paid up front in exchange for a lower note rate for the life of the loan. Now it takes time for the monthly payment savings to eat away at the price paid up front for that lower rate. You also have temporary buydowns where the rate is temporarily reduced for a period of time. The most common, and I'm sure you heard of it, is a 2-1 buydown, and that is a reduction of 2% from the note rate in year 1 and 1% in year 2. If rates are 7% today, it's a way to buy a home for a 5% mortgage payment today for that first year and a 6% payment that second year. That gives you significant payment savings very early on in the loan, and is why they've become so popular since rates have skyrocketed. Typically, it's a seller or the new home builder that gives a concession to the buyer to cover the costs of that temporary buydown. Now, there's definitely not a one-size-fits-all approach to interest rate buydowns. Any lender recommending one or the other without asking detailed questions about your financial goals and also your future plans when it comes to the property is doing you a disservice and can cost you thousands of dollars. One of the reasons why is there's a critical difference between permanent and temporary buydowns, and that is the treatment of the upfront funds paid in exchange for the lowered rate. The amount paid towards a permanent buydown is a cost that is not refundable to you if you refinance or sell your home and pay off your mortgage. That money is given to the lender upfront and you're not getting it back. Therefore, when permanently buying down the rate, it's critical to consider what your plans are for the home and how long you believe you will keep this loan. There's a break-even point, and if you pay the loan off before you get there, you're leaving money on the table. The amount paid towards a temporary buydown is treated much differently. These funds are considered the borrower's funds, not the lender's, and are placed in an escrow account. Each month, funds are taken out to make up the difference between your reduced payment and what that required payment would have been if you didn't have the temporary buydown. Now, if you decide to refinance or sell before that temporary buydown period ends, any remaining funds in that escrow account are refunded to the borrower. They are not lost. Now, every specific borrower scenario is unique, so I would never make a blanket statement about which one makes the most sense. But in an environment like we're in today, where the consensus is that rates will be somewhere between 1% to 2% lower in the next 12, maybe 18 months, a temporary rate buydown is going to be the better option for most borrowers. Now, I'd love to have this discussion with you or your clients. It kills me to see how many home buyers throw money away because their lender either isn't educating them or didn't ask the right questions to truly understand what mortgage makes the most sense for them. We're not a push button get mortgage type of lender. We create custom mortgage solutions for our borrowers based on their financial goals and how they want to build wealth in real estate, not what's best for us or what's easy for us. That's what clients deserve and why our goal is to serve as many people as we possibly can. This is Michael Menino with Harbor View Funding. Everyone have a blessed day.